In this video, we're going to start talking about aggregate supply. Aggregate supply is total production within our economy. And remember, in this model, we're interested in thinking about how total production is related to the general price level. So here, our aggregate supply curve will represent the relationship between the general price level and the total quantity of goods and services supplied or produced within our economy. Now, the relationship between aggregate price level and supply across all markets is again not clear from the beginning. Why would it be that if we had more inflation or a higher general price level, that would affect aggregate output? In fact, in the long run, we think that aggregate supply is not affected by price level. So in the long run, the aggregate supply curve is a vertical line like we have here on our graph. It is not determined by the price level or affected by the price level in any way. So to see why this is, let's start to think about what aggregate supply is determined by. Remember, we talked about this already. Production in a country is a function of inputs like labor, capital, human capital, and natural capital, and technology, efficiency, and productivity of those inputs, right? So we have this production function that describes the variables that might affect real output in the long run. All right, so you can refer back to the first video in this section if you want a little review of that, but this is the way that we think about long run economic growth or decline, okay? What means we can produce more? When we have better technology, we have more workers, if we have more efficiency in our economy, if we have more natural resources, and all of these things would lead to an increase in real output or a shift in the long run aggregate supply curve. So when long run aggregate supply increases, it looks like this. Okay, we've moved to a new long run level of output due to some change in either an input or into that A term, technology, efficiency, or productivity. What does not affect our level of output is the price level. So changes in the price level do not impact real production potential, right? We're literally talking about here, how much can we produce? If I look at the whole economy and all the goods we produce, I want to know how much can we make? That's our real production potential, or we've talked about potential output in previous videos, right? That's what we can make. What can we make is determined by our inputs and the way that we can transform those inputs into output. The price level is irrelevant to that question. And this is described by the theory of money neutrality. Okay, so the theory of money neutrality says that in the long run, if we change the money supply, if we change the amount of money in the economy, there's going to be inflation, right? Prices will go up, but it will not impact any of the real variables in our economy, okay? Output will stay the same, unemployment would stay the same, etc. Now, this is probably only true in the long run, okay? So when you get into higher level macro courses, you would take a much more nuanced view about the relationship between all of these variables. But for here, for right now, for understanding this model, this is the assumption that we're making. And it seems to be a relatively reasonable assumption because it doesn't, you know, if prices are twice as high, there's not really much reason for me to see you know, a change in output, right? Labor's twice as expensive, sure, but you can get twice as much money in exchange for selling the product. So, so in real terms, nothing has changed. All right, so we can show this kind of theory of money neutrality by thinking about how change in money supply would work in the context of this long run model. And then, of course, we're building this model mostly to understand short-term business cycle fluctuations, and we'll get to that when we introduce short-run aggregate supply. But for now, we just have long-run aggregate supply and aggregate demand, and we want to think about how an increase in money supply would affect this situation, right? So we're starting out here at this long-run equilibrium level of output and this long-run price level. And when we have an increase in money supply, it means that we're going to have more money circulating in the economy, obviously. So we have an increase in the availability of funds that banks have to loan out. That's going to decrease the interest rate, leading to an increase in both consumption and investment, shifting aggregate demand outward. All right, so aggregate demand shifts out. We have this increase in the money supply. There's more money out there circulating. People are going to go out and spend more money. They're going to borrow money. But we can't produce more stuff, right? So people have more money. They're trying to buy more stuff, but there's not more stuff to buy, right? I mean, we can't just all of a sudden magically produce more stuff without more workers or more capital or, right, better technology. So the amount of stuff we can produce is fixed. And the consequence of that is that the price level will increase, right? So that drives up prices. There's more money chasing the same amount of goods. The prices of those goods are going to go up. And this is the theory of money neutrality. In the long run, we increase money supply. That will increase prices, right? But we have the same level of output. We have the same need for labor, right? That's not going to change employment. So there's no change in the real variables within our economy, only the nominal variables, right? So what's different? A cup of coffee costs $2 instead of $1. It is still a cup of coffee, right? The real output is the same, but the nominal output has changed. Okay, good. So I'm going to leave it there for long-run aggregate supply. And then in the next video, we'll introduce short-run aggregate supply, which will help us think about understanding those business cycle fluctuations.